Welcome to our webinar 2025 Q2 Quarter in Review. Our vision is for our clients to live a life beyond wealth, entrusting us with safeguarding their financial well-being. I would like to welcome Nick Downing, our CEO and Chief Investment Officer, who founded Overberg Asset Management in 2001. For today, on the agenda, we will be going through the global economic and market review. Nick will discuss the economic and market expectations, the projected asset class returns, the OAM global portfolio, and then summarize at the end. Nick, over to you.
Thank you very much, Elsha. So we start off with the global economic and market review. This is looking back over the last quarter. The markets across the world fell sharply in response to the Trump administration's shock reciprocal tariffs announced on the 2nd of April, commonly known as Liberation Day, at the start of the quarter. As a result of much larger than expected tariff increases, the US effective tariff rate on all imports increased from 2.3% last year to around 26%, the highest in 131 years. President Trump was quick to de-escalate the crisis. Within a week of Liberation Day, Trump announced a 90-day pause on reciprocal tariffs on all countries except China, and a few days later, the US and China each suspended for 90 days all but 10% of their Liberation Day tariffs and cancelled other retaliatory tariffs, restoring stability to equity markets. The Middle East conflict intensified after Israel struck Iranian military and nuclear sites on the 13th of June, sparking missile and drone launches from Iran. The US entered the conflict on the 21st of June, striking Iran's nuclear sites, and Iran retaliated by firing missiles at the US airbase in Qatar. The broadening conflict caused the oil price to jump, and it may have surged higher if Iran had blockaded the Strait of Hormuz, through which a quarter of the world's oil is transported. Fortunately, the ceasefire on the 24th of June marked the end to the 12-day war, and the oil price has returned to its pre-war level and is now lower than at the start of the year. Despite trade war uncertainties and the Middle East conflict, global economic data remains solid over the quarter. Although US GDP shrank in Q1 by 0.1% quarter-on-quarter, the setback was due to a once-off surge in imports ahead of the tariffs, lower government spending. High-frequency data indicates Q2 economic activity is robust, consistent with the Fed's target of 1.3 to 1.4% GDP growth in 2025. Elsewhere, following years of being overshadowed, the pace of growth in other regions appears to be converging with that of the US. The UK economy grew in Q1 by a solid 0.7%, and the emerging market giants China and India by 5.4% and 7.4% respectively, both year-on-year rates. This chart shows how the pace of growth in other regions appears to be converging with that of the US. The dark blue line indicates a slowing in US GDP growth, while the pale blue dotted line indicates an acceleration in non-US developed market growth. Meanwhile, US growth is falling further behind that of many emerging market economies, including China and India. US inflation continued its gradual decline, although the Federal Reserve left the Fed funds rate at 4.25% to 4.5%, unchanged since December 2024. Chair Jerome Powell said, excuse my American accent, what we're waiting for to reduce rates is to understand what will happen with tariff inflation. There's a lot of uncertainty about that. Other major economies were much better off from an inflation viewpoint, with profound implications for central bank easing. Eurozone CPI declined to 1.9% in May, under the ECB's 2% target, facilitating 25 basis point rate cuts in March, April, and June. The ECB's deposit rate is now at 2%, less than half the Fed funds rate, and the absence of tariff-induced price increases suggests lower inflation and interest rates ahead. By contrast, the Fed will be hamstrung by rising inflation expectations. After falling sharply in April, equity markets more than recouped their losses by the end of the quarter. Japan's Nikkei 225 index led the way, with a 13.7% gain, culminating in a 1.5% return for the year to date. The US S&P 500 index gained 10.6% in Q2 and 5.5% year to date. Germany's DAX increased by 7.9% in Q2 and a solid 20.1% year to date, while the UK FTSE 100 gained by a more modest 2.1%, 7.2% respectively. In China, the CSI 300 index was stable, with gains over the quarter and year to date of 1.3% and 0.03%. At face value, US market gains were impressive, but remember, the US dollar lost significant ground due to policy uncertainty. The US dollar index fell in Q2 by 7.1%, amplifying its year-to-date decline to a sizable 10.7%. As a result of the dollar's decline, most other markets fared better than the US in common currency terms. So let's look ahead. The next section will be on economic and market expectations. Markets and policy attention in the US is turning from trade tariffs to fiscal stimulus with the passage of the One Big Beautiful Bill Act through Congress. The stimulus package is projected to amount to between $3.3 and $3.8 trillion over the next decade. Other regions are also pursuing fiscal stimulus policies, notably Germany, where as much as €1 trillion is expected to be spent in the next decade, equal to well over 1/5 of GDP. Benefits there will spill over into the rest of the Eurozone, provide a catalyst for improved consumer confidence and retail sales, and potentially unleash the €1 trillion stockpile in accumulated excess savings. Although to a lesser extent, China is embarking on its own fiscal stimulus to counteract the impact of US tariffs. Tariffs have caused US short-term, one-year inflation expectations to spike high as businesses pass on import price increases to end consumers. However, longer-term inflation expectations have barely budged since tariffs were announced, signaling that the inflationary impact of tariffs will be temporary. As a result, the Fed is expected to see through the inflation spike and is projected to cut the Fed funds rate twice in the second half of the year and once more in 2026. Outside of the US, inflation is expected to maintain its current downward trajectory even over the short term, adding more certainty to further interest rate cuts. The global economy is already on a firm growth trajectory. Additional stimulus in the form of fiscal policy and easier monetary policy will serve to strengthen and lengthen the economic cycle, more than compensating for any fallout from tariff increases. The positive economic cycle will translate into healthy corporate earnings growth, which should continue to drive equity markets higher. Equity markets also tend to perform well when interest rates are lowered. The path of least resistance is for equity markets to remain on an upward path. The US market is expected to outperform between now and the end of 2027, helped by fiscal and monetary stimulus, continued enthusiasm over AI, and its economy being better suited to benefit from AI. However, the US market may outperform by less than it did previously due to its significant valuation premium to other markets. Economic growth in other regions, after long being overshadowed, is starting to catch up and converge with the US. Other regions, as well as enjoying economic growth convergence with the US, also expected to experience a convergence in corporate earnings growth. In particular, Europe, due to Germany's seismic fiscal policy shift, Japan, due to its reflation and corporate governance reforms, Japan, again, as well as developed Asia-Pacific economies in China, due to their large weightings to tech sectors, and China, again, due to its more friendly approach towards the private sector. Convergence in the pace of 12-month forward earnings growth between the US, shown here by the dark blue line, and the rest of the world, the light blue dotted line, indicates relative earnings momentum has shifted in favor of non-US markets, reflecting a weakening US dollar, slowing US earnings growth, and improving earnings growth in select non-US markets. Despite its recent depreciation, the US dollar remains overpriced relative to its own historical trend. The dollar is heading into a structural bear market, which is a possibility given the extent of the country's budget deficit and ballooning government debt, only to rise even more with the One Beautiful Bill. It is instructive to examine previous dollar bear markets. There have been 3 structural dollar bear markets in the past 6 decades, in which the real trade-weighted dollar fell by an average 32%. In each case, the dollar fell 40 to 18% below its long-term trend line before bottoming out. It is currently 17% above its trend line, leaving ample room for further depreciation. Right. So let's look at OAM's global portfolios. It's been quite an active quarter in terms of changing the investment structure. Changes were made in the past quarter across global portfolios, aimed at increasing the weight to cash. In the global growth portfolios, we sold 2 of the more specialist equity mandates due to their greater inherent volatility, including International Biotech and Vina Capital Vietnam. There is a high degree of uncertainty over the impact of pharmaceutical tariffs on the life sciences sector. Meanwhile, Vietnam has been one of the most heavily punished economies in Trump's trade war. And to make matters worse, it is one of the most dependent on exports to the US. In the global balance portfolios, we raise cash by selling real estate credit investments to lower the exposure to specialized debt. On the risk spectrum, specialized credit lies somewhere between equities and bonds, and the widening in credit spreads expected in an uncertain environment would affect investment returns. Part of the cash raised was used to lift portfolio weightings in European equities via an increased exposure to Fidelity European Trust, held in portfolios since November 2022. As mentioned already, there has been a seismic shift from Germany's traditionally conservative and debt-averse fiscal policy, with significant consequences for economic stimulus. Benefits will spill over into the rest of the Eurozone, making the policy shift a game changer, not just for Germany, but for the whole of Europe. Moreover, European shares are very cheap relative to the global average, providing scope for a significant re-rating. We also added 2 defense exchange-traded funds, ETFs, to portfolios. The VAM EC Defense ETF provides diversified exposure to global defense companies, including those in defense technology and cybersecurity, spanning firms across the US, Europe, and Asia. The Wisdom Tree Europe Defense ETF tracks the performance of European defense companies, offering a pure play exposure to that region's surge in militarization. As the world pivots from arms control to arms proliferation, the need to modernize military capabilities after years of neglect and the rapid change in defense technology will require long-term spending commitments for at least a decade or more. Besides capitalizing on the increased spending in the sector, defense exposure also reduces portfolio risk, acting as a hedge against political instability. And regardless of economic cycles, governments will continue to allocate large budgets to defense spending. While the US equity market is expected to outperform between now and the end of 2027, we are aware that it trades at a very high valuation relative to its own history and relative to other equity markets. This means that the US exceptionalism theme is already well discounted, and on a 10-year horizon, other cheaper markets may offer better prospects. This chart going back 30 years shows the price-earnings multiple valuation premium of the US equity market versus the rest of the world. At a valuation premium of more than 50%, there is a risk that the exceptional attributes of the US equity market are close to being fully discounted, and that other cheaper markets may offer better investment prospects over a longer-term horizon. Overberg Asset Management's global portfolios have a sizable weighting to the US, but slightly below the US weighting in the MSCI All-Country World Index. After years of outperformance, the US weighting in the MSCI World Index is at an astonishing 65%. We do not believe US dominance can be maintained at this level indefinitely. Indeed, with the expected narrowing of the US's economic growth advantage in the years ahead and continued downside risks to the US dollar, there is a high likelihood of an eventual global equity market rebalancing away from the US, when we expect other markets to do well too. Meaningful global diversification Complementing US with non-US exposure will lower overall portfolio risk and capture attractive growth opportunities from historically cheap valuations and a recovery in growth and earnings. There is scope for solid returns in Europe, Japan, the tech-focused Asia-Pacific economies, and China. Projected equity index returns between now and the end of 2027. We think the stage is set for further decent returns in equity markets over the next couple of years. This chart from independent research firm Capital Economics shows the percentage equity index returns expected over the remainder of this year, in 2026 and 2027 in the major market indices, including from left to right, the US's S&P 500, the German DAX, the UK's FTSE 100, Japan's TOPIX index, the MSCI Emerging Market Index, and on the far right, global equities in US dollar terms. All other returns are in the respective local currency. Overberg Asset Management has a long track record in managing global private share portfolios, going back to 2022, almost a quarter of a century. £100 invested 22 years ago would now be worth close to £500. It has not been a straight line. It is not timing the market that compounds investment returns, but staying in the market. The annualized return in pounds sterling net of all fees is 7.04% over the past 22 years, and in RAM terms, 9.64%. Asset allocation and global allocation is diversified across asset classes, across regions, across currencies. It is truly a global, actively managed, multi-asset class portfolio. The balanced portfolio shows a similar trajectory, although due to its lower equity exposure, exhibits less volatility. Surprisingly, the annualized return is in fact slightly above that of the global portfolio due to unusually strong returns in the bond market in the decade following the 2008-2009 global financial crisis. Let's turn to summary. Investor attention is turning from the damaging on growth, on earnings and inflation of tariffs, to the beneficial effects on growth and earnings of fiscal stimulus. Central bank interest rates remain on a downward trajectory, even in the US, where the Fed is likely to view the tariff-induced impact on inflation as temporary. The US dollar could bounce from its short-term oversold levels, but is at risk of declining further over the medium term. A weakening dollar helps drive global liquidity and non-US markets. US markets were expected to outperform between now and end 2027, only just. Their dominance is being challenged. The overall outlook for global equity markets is positive over the next 2.5 years, driven by solid earnings growth across all regions and compelling valuations in non-US markets. Portfolios are well positioned with a slight underweight exposure to the US and meaningful regional weightings in Europe, Japan, and Asia Pacific. Portfolio changes in the past quarter include increased exposure to European markets, as well as the initiation of exposure to the defense sector. And with that, I want to say thank you for attending our webinar. Please contact us if you'd like any further information or have any questions.
Thank you, Nick. It was a very thought-provoking presentation and interesting about the defense ETFs. We thank you for your time.